Tech is down, but energy and basic materials are up. Utilities are flat. Industrials are okay. Headline index doesn't speak to the fact that we have a major conflict in one of the most important areas in the world.
Equity should be down 10% or more based on what's happening around the world. And the fact that it isn't, maybe by next week.
Canada is, quote, urgently exploring options with provinces and the energy industry to boost oil supply as trade disruptions caused by the war in the Middle East spur huge volatility in global crude markets.
Who's writing that article?
Bloomberg.
I'm going to get angry. We've been talking about this for years. Fossil fuel demand is not going anywhere, and we have a moral imperative to build out our supply chain, and this is exactly the point.
So are we doing a Bank of Canada Twinkie bet?
Oh yeah, let's do it.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
What does it look like when two leaders, each defined by experience, innovation, and performance, unite to elevate Canadian real estate lending? With nearly a decade of serving the needs of investors, borrowers, and mortgage brokers in the alternative market, Neighbourhood Holdings has now taken a major step forward by acquiring Fizgard Asset Management, forming one of the largest alternative mortgage lenders in Canada. Together, they manage nearly $800 million in mortgages across more than 2,000 borrowers and over 3,000 investors nationwide. Through the Neighbourhood banner, the team works directly with mortgage brokers across Canada, providing short-term mortgages for quality borrowers who may not fit traditional bank criteria. Every loan is backed by real assets, ensuring a measured, conservative approach, seeking to provide investors with stable income while preserving invested capital. Whether you're a mortgage broker seeking flexible financing options or an advisor looking for regular income solutions, Neighbourhood's expanded reach brings track record, transparency, and opportunity, now even stronger with Fizgard's 30-year legacy. To learn more about the Neighbourhood, visit neighborhood.com to view the offering memorandum or speak to your financial advisor today. This is not advice, and consult a professional advisor before investing a Loonie in any of these investments.
Welcome back to the Loonie, our episode 232. As always, joined by the three amigos. We've got the Boomer over in Dominican Republic, Rich Diaz in Montreal. So welcome back, Richard.
Hello, how's it going?
Good, you?
There was I don't know if some of you guys are familiar, but 1998, I think, or maybe it was 1994, whatever. In the 90s, there was a humongous ice storm that like basically froze the city for 2 weeks. And as a child, it was glorious, basically, because right after Christmas, we got an extra couple of weeks of vacation. Well, a tiny version of that happened last night, basically. And there was like, one of the only things that Quebec is really good at. We used to be good at producing hockey players. We no longer do that, but we're really good at snow removal. And yet yesterday was crazy. The whole city was just like blanketed with like an inch thick layer of ice on like all the cars, all the roads, all the sidewalks. And for the first, it was like my mom and my sister, who are obviously older than me, had like PTSD. They had like flashbacks of like this ice storm from the 90s. But yeah, the whole city was kind of locked down for half a minute, but thankfully we've thawed out. So there you go.
I remember that. That was one of the biggest Canadian natural resource catastrophes. You want to call it
disasters? That? Yeah.
It was enormous back then.
Yeah.
It was.
Do you remember it, Keith?
Yeah, absolutely. Yeah.
Yeah. Anyway, there you go. That's it for me.
And I wasn't a little kid either. I was a kid.
Boomer, any ice over there?
No ice. Look at my party shirt, guys. You like it, Rich? I have a palm tree, surfboards, and I think that's some water. I think
for anyone that doesn't have the visual, it's just the ultimate dad vacation shirt.
Yeah, that or Mr. Smithers.
Yeah, something like that. Yeah, hanging out with Mrs. Icecap for a few days down in the sun. It's been real nice down here. Oh, Rich, I got something for you.
Uh-oh.
You know when you were over in Portugal, you had like the super box. Is that what you call them?
I love super
box. They have little beer here. They're called.
What is that? Presidente.
Put it up to the screen. I can't see.
If I put my head forward and the beer back, it looks really tiny.
Yeah, it's true. How big is it? Oh, look how tiny it is.
Yeah, it's kind of tiny. It's 237 mil.
Oh, that's even bigger than the super buck. Here you go.
The Presidente.
Presidente.
Okay, good. Well, it's 12 o'clock somewhere.
Let's go for the taste test of the Presidente. Tastes like beer. Steve, what's going on there? Your neck of the woods. Selling any houses this week?
Yeah, no, it's a grind out there. It's
Can anyone get credit anymore, or are they all shut down?
Well, the developers can't, but everybody else seemingly. The banks are still lending. The banks are still lending. Actually, speaking of which, funny enough, there's actually an article out this week from OSFI, our banking regulator, so you remember we talked about a story that's been happening. We mentioned on the pod probably over a year ago now, where there was sort of this theme that was developing, which is all these people that bought these pre-sale condos in 21, 22, 23 that were coming up for completion, let's say in 25 or 26, et cetera. The values had changed, right? So let's just say you bought a condo for $1 million. Well, like everyone knows the value isn't $1 million anymore. You bought a pre-sale at the peak of the market. That $1 million condo was really worth, let's say, 800,000. But the banks were still lending on the basis that it was worth $1 million. Because basically what was really happening was the banks were ultimately involved on the construction side of the loan as well with the developer. So it's either if you have a whole bunch of your pre-sale buyers that can't complete because their units don't appraise and they can't come up with the equity, the shortfall to close, then you have a problem with obviously the construction loan. So what the banks and OSFI have effectively been doing is they've basically been turning a blind eye, and they've been issuing, not all banks, but a lot of the banks, a lot of the big ones, have been issuing, in many cases, loans at 100% LTV or even greater than that, because they'd rather sort of kick the ball down the road, which is to say, let's get Rich to close on his pre-sale. He's underwater today, but let's just hope that, he makes his mortgage payments. And, if he defaults in 3 years, like we'll figure it out then. And so that's kind of what they've been doing, is they've been calling them blanket appraisals. Well, there's this article out in the media this week saying Canada's banking regulator warns major lenders about appraisal practices as condo prices crash. And so effectively, Reuters says that obtained meetings through access to information requests, they show how the Office of the OSFI, the regulator responsible for the stability of Canada's financial sector, is scrutinizing some mortgage approval practices more closely amid growing concern over the potentially broad economic impact of a collapse in Canada's housing market. Of course, OSFI declined to comment on meetings with the banks, but people were starting to share this article saying, "Oh yeah, OSFI they finally figured it out. They're going to shut down this practice, and this is good." And the only thing I can tell you is someone that is in the industry that talks to these bankers regularly. This is all bullshit. The OSFI's known about it for a long time. They've more or less, yes, they've talked to the banks. They've given them that stern warning. But it's kind of, what's the old saying, Rich? Like everyone's just in agreement that this is going on, and everyone is
don't ask, don't tell.
Yeah, don't ask, don't tell. Hey guys, you guys shouldn't do this. Can you tighten up the requirements a little bit? Like that's
what's so
pretty much
ironic with this, though, Steve, because you brought this up well over a year ago that it was happening. As you said, everyone is aware of it and familiar with it. And now finally, you're getting, finally a regulator is coming out with, a stern warning, about it.
years later.
Yeah, years later.
Yeah, no, it's.
But who are they warning? What is the warning though? Are they warning people not to get a mortgage?
They're warning the banks, saying,
banks
hey,
not to do it.
Yeah, they're warning the banks, the big banks, that this practice, can't be going on, shouldn't be going on. Please don't do it. But we won't really do anything if you do it. It is kind of the gist. Because again, what's happening? Like, I'll give you an example. I was chatting with a lender, this week, which is he's like, oh yeah, we had this pre-sale, and came across our desk, and the guy had paid 1.4 million pre-sale, just appraised at $1 million. Right, it's a $400,000 shortfall.
Yikes!
Right, but if you have a blanket appraisal with one of these big banks, hopefully they've got a blanket on there, and you can still get an 80% loan potentially on 1.4. So then you don't have to come up with that extra cash to close. You just close. Yeah, you're underwater, but at least you haven't defaulted, and at least the developer isn't now stuck with outstanding with inventory that's coming back on the books.
So it's like the emperor's new clothes. If everybody agrees that he's wearing something, then he is. Excuse me.
Yeah,
and all it takes is for one.
No, I think they're agreeing he's wearing something, but
Yeah.
he's clearly not wearing
exactly.
anything.
That's what I that's what I meant. I garbled that, but you get the idea. I mean, yay. I mean, okay.
Brian, long story short, the practice is still happening. Fade the news article headlines that OSFI is actually going to do something about it. This practice is almost certainly going to continue for the foreseeable future, because the pre-sale condo space is a disaster. It is still a disaster, and
But Steve, the BC housing minister says housing data is strong, suggests strong interest from the development community.
Oh yeah, I got a kick out of that one. Yeah, it's like, man, I don't know.
I don't think it's a disaster. I think it's a gully. That's all.
Just a gully.
It's just
the
gully.
BC housing minister was like, I think what was she saying? The housing data suggests that the developers are still excited about construction or something along those lines. And I was like, man, like, you couldn't be further off the pulse. It's crazy. There's defaults, and there's a insolvency that came up in Vancouver a couple days ago, actually, where it's like the one developer, but he had two buildings that are like fully completed units, and that are like, going bust. It's just, inability to pre-sell. I think so many developers held too much inventory back, thinking the good times would continue. And then the building completes and you still have 30% of the units that are sitting on your books that you can't sell.
Okay, but I have a question about this. Surely at one point there will be a pool of capital that will swoop in and happily, with a long enough timeline, sufficiently well capitalized. Let's say the Steve Saretsky Real Estate Investment Fund. We're starting to raise capital for that, by the way. No, I'm joking. But you know what I mean? Like, you just have like, there are pools of capital. Let's say the Canadian Pension Fund that could be like, oh, we'll buy these condos at 40 cents on the dollar or 30 cents on the dollar.
Yeah,
isn't that possible?
I mentioned that on the pod. What was it, like 3-4 weeks ago? Keith, this guy not paying attention on the podcast.
Yeah, that happens every now and then.
So I mentioned there's that group, anyways, that I was made aware of, let's put it that way, where they are, yes, they're doing what you said. They effectively are raising money. And one of the investors in that is actually the Ontario government. So the Ontario government has like a housing affordability, effectively slush fund. And so they're coming in with capital and saying, yes, we'll partner with you on this. You go buy up, whatever, 100 units. And if you make whatever 20% of them affordable rents, we will basically, cut you the check. So
yeah, it always freaks me out when the public gets involved, as demonstrated by years and years of abject failure and incompetence. But I'm more curious about like not BlackRock's, but there are large companies that just buy up. Like, for example, I rent from a Danish company called Inquries. That's the flat that I'm renting. They own lots of different apartment buildings. They own the apartment building to my right. They own this one. They own the one down the street. I mean, at what point do these sort of large rental companies find it lucrative to purchase these condos at 40, 50, 60 cents on the dollar and just start renting them out? Or I don't think you'll see
I don't know. I'd be surprised if you saw like a apartment REIT style company go in there, because I think, as in a REIT, do you really want to own 12% of the building, and then you're part of a strata where you have to deal with 88% owners that are a mix of people. So these people typically want to own and control the asset, and obviously if you own 12% of the building, it just it's not
attractive. It's too much of a pain. Okay, I didn't realize that makes more sense.
But yeah, so that's kind of what's going on. Fade OSFI, falling rents. We got that is still continuing. Rentals.ca with their report out this week showing that rents have now fallen for, what are they at now? 17 consecutive months. So national rents are down 7.4% over the past 2 years, falling for the 17th consecutive month. So the trend is in place.
Not in Winnipeg.
The peg?
not in Winnipeg. We always mention Red Deer, and then we got an email from somebody who was like, why are you guys always ragging on Red Deer? We're not ragging on Red Deer. Hopefully one day we'll have a Loonie Hour meetup in Red Deer. We hear it's lovely. But
I think it's more of an affectionate
exactly. It's an affectionate ribbing. Yeah. So to the gentleman who wrote us a stern warning about making fun of Red Deer, it was not to mock you. It was just we need to sprinkle. We always talk about Vancouver and Toronto. We got to mix it up.
But one thing that's good here, I always talk about the trend and can you reconcile what's happening. But if the real estate market is, grinding lower, rents should be as well. So because that's happening, I do think, Steve, and if someone will come in eventually, the market will work its way out. But I mean, down here where I am right now, everyone's talking about, JP Morgan, Morgan Stanley, BlackRock, Blackstone.
They're talking about at the Summit Bar?
Is that what they? Yeah. No, at the buffet.
There's some pretty big credit concerns taking place right now. So I think it would take a brave pool of capital to go into that world, this week. We'll see what we can do with it.
Keith,
it's just interesting. Everywhere we look, there's another credit story blowing up, again.
Yeah, we're gonna get to that. But this kind of segues on the housing front. Obviously, the weakness, the trend is in place. This kind of leads to the Bank of Canada, Rich, I think, is next week.
Mm-hmm.
What are the market odds right now for the BOC?
All right. Excuse me. Sorry. So it's a 93% probability of no change. The meeting is March 18th.
I think,
and
probabilities are moving higher towards a hike.
Yeah, so that's what I think is really cool. Remember, we always we warn people about putting too much emphasis on the next December meeting, but that has moved up from 23% a couple of weeks ago to now 80% chance of a hike in December of 2026. And so right now we've got hikes being priced in for midsummer. So now there's a 40% chance of a hike in July. So Keith can tell us why that's happening. But it is interesting Keith, that the curve, remember, the overnight index swap curve that predicts the future path of interest rates is starting to bend higher and higher.
I'm going to say this, Keith, before you step in. If you get a hike from the BOC this summer or the fall, I think that's going to throw a lot of homeowners for a loop. I think people are still of the view, I mean, I'm probably somewhat of that view, but that rates are going to get cut or move lower. I think that would really throw people off guard. I think people haven't even mentally thought about the idea of a hike from the BOC.
I think the challenge here is, again, you have the industry and by the way, pricing rate moves out into the late summer and into December. I wouldn't put a lot of weight on that at all. But you have the theoretical world of finance where what really, if it's showing you that rates are going higher, it's telling you inflation is going higher. That's what all this is about. Yeah. And I would agree completely. I mean, we've been in the sort of the sticky inflation camp, for a while. With the war in the Middle East now, I think prices are just going to skyrocket here. And based on that, the theoretical guys, on Bay Street or Wall Street, wherever, Rich, Threadneedle Street, is that the big one over there?
Yeah, that's it. Threadneedle Street. That's where Mark Carney kept interest rates way too low for way too long.
Yeah. They're on the belief, well, inflation's going higher, we have to hike rates. And no matter how high they hike rates, it's not going to control that kind of inflation. Because inflation will be created, from the energy world and everything that goes, upstream and downstream from it. So if rates are higher or lower, it's not going to matter with that. So I would take the under on both of those probabilities that you just shared with us, Rich.
Yeah.
I think they're going to be. So at some point, the Bank of Canada, Steve, they have to make a decision. Are we going to be, true to our goal, a mandate to fight inflation, or are we going to try to bail out, the economy and the housing market? And eventually, they always change. So, however, if rates go lower, what does that mean for your mortgage rate world, Steve?
If the rates move lower,
yeah.
Well, I mean, lower rates obviously help housing demand. I mean, people buy mortgage payments, right? So,
Did you hear that on the island? I think it's going to be one of these examples where, because I mean, you have the private credit thing happening at the same time as well. I think you can see central banks cut rates, but credit spreads, they stay where they are or they go higher even. I don't think mortgage rates are going to go lower at all in this scenario.
Keith, credit spreads, they're finally moving.
This much? Is it?
No, if you squint.
Is it the size of my beer? It's like a little tiny
you the chart.
one.
I sent you the chart. I told you. We talk a lot about corporate credit spreads and the reason that they're not moving or not moving anywhere near as much as they, our extinguished and the discerning views that they should be rising, and they have in fact moved a little bit. They're now up to almost 700 basis points. So just a little bit.
From where were they though?
They were, maybe 550,
675. Oh, well, okay. Hey, that's
so they're on the chart. You can barely. I had to zoom in on the chart to see, just to give you an idea. They were like 1,200 basis, like 12. It was like 12% at the end of 2023. So it came all the way down, and they're starting to creep up with all this stuff. But anyway, still very low.
question.
Yeah.
So are we doing a Bank of Canada Twinkie bet?
Oh yeah, let's do it.
Keith, you go first.
Keith was frozen. I didn't hear the question.
Presidente, go ahead.
It's a lot of Presidente. I didn't hear the question. I apologize. I was frozen. No move for me.
Rich?
Yeah, my bet is no. You can see the Twinkies back there. Fresh box. No move. I'm not going to go against 93%.
Well, I'm not going to take the reputational damage either. So,
let's make another bet. Let's bet on how many questions there will be about. No, I don't know. I'll think of something else we could bet on the press conference or something.
But the response though is going to be, there's, used to be, the tariffs was creating all this uncertainty. And now it's going to be about, the wars creating all these uncertainties.
Yeah, exactly.
And it's going to be interesting, though, if they do get the real question they should get, will the Bank of Canada hike rates because of inflation data that's being driven by the energy world, in which you would also comment, whoever's listening to this is going to be in the room. As Tiff or Carolyn, Rich's friend.
Keep her name out of your mouth.
Oh, I'm sorry. Will Smith. Whap. Again, no central bank in the world can change rates to affect inflation caused by the energy market. Let's see if we get that question, everyone. Let's keep score with that one.
Keith, I'll kind of side with you on that. I think that, clearly inflation is going to be moving higher given energy prices, but I have to think.
Didn't we just have inflation data just from the Americans? Was it this week, Rich?
Yeah, it came out.
And that was for last month, before the war started. So that number doesn't mean anything right now. Is this the next one?
What did it come in at, Rich?
2.4% year on year. It was in line with expectations. 0.3 on the month. And core is 2.5. I told you 3 is the new 2. Man.
Yeah. Well, true. Everybody, I think we've got to put a little bit of weight on trueflation. 1.2%.
Going down?
Well, and won't go down anymore.
No, that's true. Yeah.
$100 oil, Keith. Good, nice call, buddy.
Yeah.
Yeah. Do you want to do war stuff next, or do you want to?
I think so.
World.
Yeah. Well, I think I don't know. Maybe just to touch lastly on the BOC. I don't know if they're going to look at go easy. But
hey, sorry to interrupt the show. Just want to let you guys know we have 2 Loonie Hour events coming up on March 23rd and March 25th. One in Calgary and one in Vancouver. The Loonie Hour Investor Series with special guest Ben Rabidoux, basically doing a presentation plus Q&A on the Canadian housing markets, global markets, and outlining investment strategies to protect and grow your wealth. The first one is in Calgary on March 23rd at the Ranchman's Club, and as well to the event in Vancouver March 25th at the Vancouver Lawn and Tennis Club. There'll be tickets in the description and show notes below to an Eventbrite page where you can buy tickets for $40. Open bar, we'll take care of all that. Food as well. So a good opportunity to come out, meet the guys, engage, ask a few questions, learn about the markets, and look forward to meeting you all there. So once again, there is a link in the description, in the show notes below, to Eventbrite pages for both of those events. Look forward to seeing you.
So what happened there?
Go through that story, Steve, first for everyone. It's pretty spectacular in whether it's a legitimate or non-legitimate way.
So Go Easy shares, which is effectively a subprime lender, the shares fell 57% on surging loan losses as they suspended their dividend. So it's a personal lender for subprime borrowers, shocked investors by announcing surging loan losses and suspending its dividend earlier this week. Shares fell 57%. Based in Mississauga, Go Easy made its name by lending to lower quality borrowers during a credit boom fueled by ultra low interest rates between 2015 and 2025. The company's shares soared more than 1,000%, and investors salivated over Go Easy's breakneck loan growth, coupled with 11 consecutive years of dividend hikes. Lately, though, there have been growing concerns with the quality of Go Easy's loans. So there you go. It's starting.
Yeah. The question is like whether or not, if we do get, let's say we get continued weakness in the Canadian economy, unemployment does go up, and interest rates do get cut. Do you get a rebound in these stocks? I don't think so personally, but it'll be interesting to see. Maybe we've been wrong before and we'll be wrong again. It'll be interesting to see how they react.
I just don't think this is all played out yet. I mean, there are a number of air pockets in financial markets right now. So on the surface, it means you can't see them. Everything still feels, okay. But when you start, looking under the hood a bit deeper, and then you say, oh, wow, yeah, this is a big one. So the whole, sort of subprime debt lending, should that blow up based on the trends that we've been talking about? Yeah, absolutely. So it's not a surprise. Is it Go Easy? Is that what you called them, Steve?
Yeah.
Go easy, yeah. Go easy on them, Keith.
They're changing. It's Go Hard now. I think they're difficult. It's going to be tough to play it out. But again, so normally you get credit deterioration at the lower end first. So that is happening. And we saw it in a lot of Canadian, private credit, real estate focus areas about a year ago. And now it's starting to spill over to the other parts of private credit. So again, I don't think we're at the end of this at all. And the fact that now Wall Street is involved with this, JP Morgan, Morgan Stanley, and all this stuff, we're doing this on Thursday. On Friday afternoon, there could literally be a big credit event. And everyone's going to say, hey, you guys missed the biggest story. But that's how fast this is moving. Because you got to talk about so if you're in a private credit fund, now like the US focused ones, and by the way, there are a lot of great private credit funds out there. Like there really are. It's just the bad ones, the one that gets stretched, they're using like level 3 accounting, so that the value things, that's what's breaking first. But as soon as you get a bit of a whiff that something is bad and you're holding something close to that space, I mean, like, what are you going to do, Rich?
Sell it. You just de-risk. It's as simple as that. It doesn't matter if you're specifically tied to that. You just de-risk.
Yeah, you get out, right? And all of a sudden then you sort of create the mini bank run yourself. But the other interesting thing, like a lot of institutional money out there, they're locked into private credit as well. And they can't get out. They know, like they just can't do it. But they would have to de-risk in other parts of the fixed income world. So that's when you see them, reducing what they can sell. So whether it's, investment grade or below investment grade, things like that. So this is getting really interesting right now. I know the war gets all the news right now, like all day long. But these credit stories, again, I think air pocket is the word or the term to use. And so you're just flying along and, you're down 10, 20%. Then you react to it. Usually when you're on a plane and it drops that much, what are people doing?
Eating snacks.
Grabbing the vomit bag.
Yeah.
Keith, like, we talked about the big ones out of the US, Ares, KKR, Blackstone, Blue Owl. That's Blue Owl is Steve's favorite. And then Apollo, my favorite, because I love the Apollo space mission. But all of those are continuing to decline. There's no there's no bounce. Whereas we remember we talked about software as a service. Well, actually, it looks like a bunch of those have actually stopped falling. So it's funny that those two stories are sort of going in different directions. Private credit is getting worse and worse. And for the software as a service is a theme we talked about a lot. And I'm sure, and I butchered and then was reminded of my ignorance in many, many emails. Thanks for that, by the way. But those stocks have actually stopped falling.
COBOL. COBOL. I think that's what you did.
Yeah, I screwed that up. But anyway, it is interesting how those two stories are going in different directions now.
And that's like with the financial market response, since the war has started, it's 2 weeks, right? That's it. That's what we're into. I think a lot of people would agree that, energy is doing what it should be doing because of where the war is. Mm-hmm. But I were surprised by the reaction from equities, for example. Mm-hmm. Some parts of the market are down, a bit more aggressively than others, but overall it hasn't been the response. So if I said to you guys like a year ago, hey, a year from now, this is going to happen in the Middle East, and Steve's favorite spot on earth these days, the Strait of
Hormuz,
it's getting mined and stuff like that. Where would equity markets be? I think everyone on planet said, "Oh, they're down 20%." At this point, that's not happening. So it's a bit odd, with the. No, this is insensitive, but the financial market response from this. But yet, I think the longer it goes on, and the longer energy prices do what they should be doing, because that is where we are. All of a sudden, it's getting priced from being like a short incident or a crisis or whatever to, it's getting stretched out further and further as we speak. Eventually, what you're going to start to see next is, all these higher energy prices that are going up and down through the daisy chain. Companies will start warning. Anyone that's heavy industrialized and they need, their input costs are affected by that. So maybe that will create an air pocket somewhere. We don't know. But again, we're getting some really unusual responses. But I think if there is an air pocket hit, it'll come from the credit side right now and not from the
just to put some numbers on it. Just to put some numbers, if you like rebate, the series I like to look at I look at lots of stuff. But anyway, but one is like broad market X financials. So for the US, just to give you an idea, we're basically exactly where we started on January 1st. So it is basically, we've done a round trip of we're basically only down maybe 4 or 5% from the highs, which is really incredible. Just to put
so since the war started, it's down 4 or 5%. Is that what you mean?
Yeah. And that's just and then I excluded financials because financials getting dragged down by all of those private credit names that we know. But yeah.
And how's that market looking from the high this year?
The financials, they're down quite a bit, almost 10% from the high, or 12% from the highs. Financial services are down 12% from the highs. Banks are down 10% from the highs. But the market X those financials, again, they're propped up because it's right. It's it's a weighted average of all these different industries. Tech is down, but energy and basic materials are up. Utilities are flat, industrials are okay. But it's just that your point is right, which is the headline index is actually basically, you can barely see that the change, or it's just a normal sort of, it doesn't speak to the fact that we have a major conflict in one of the most important areas in the world, really.
And we have to continue to watch the U.S. banks, especially right here, because again, we mentioned J.P. Morgan, earlier, the
Morgan
biggest
Stanley
bank.
as well.
And Morgan Stanley as well. As soon as these guys see these things, they tend to retrench, as well. So, your economy can't grow without credit. That's just the way things work. So, financials are moving in that direction. So we'll see if there's, again, maybe the rest of the market, is the air pocket comes down to the financial side. Again, equity should be down 10% or more right now, based on what's happening around the world. And the fact that it isn't is just, okay, again, maybe by next week, we're at that point. But I think the biggest story, though, coming up, we've been talking about energy market, for a while. And, I think most people now are aware with what is happening with oil. But the other big market underneath that we're starting to see movement with is the food agriculture industry and business. And again, that makes perfect sense. So fertilizer prices are going higher. You'd expect to see food going higher as well. So we're starting to see that, feed through what we're holding. So that is making sense. The credit side, not so much.
Keith,
Yeah.
the urea, ammonium nitrate, granular from New Orleans. If you want to be a dick about it, no, there's like loads and loads of different futures contracts for different parts of the world: China, West Coast, East Coast, Canada, whatever. But anyway, the one that I look at is the one from New Orleans, is up 35% over the lot since the beginning of the year, which is crazy.
That's a big move. That's a big move.
Yeah.
Rich, can you say that again?
So urea, which is ammonium nitrate, which is the input to which is fertilizer, basically, just to keep things simple, is up 30%. That's from that specific port. Each port will have a slightly different price because of transportation costs and where they get it from and blah blah blah. So I can't track them all. It's too cumbersome. So the one I just chose is the urea from New Orleans, and the natural gas price series that I track is called TTF, which is out of the Netherlands. The one, if you're curious about the US, it's called Henry Hub, which is far less volatile. But the one natural gas, and that's up like almost 50% from the lows at the end of last year. And they moved together.
How's the European number looking?
Yeah, that's the TTF. That's from Netherlands. That's 30%. Sorry. That's almost 60% from December 31st to now. It's almost doubled. It's like 70%. So when it went from like 30 something dollars per megawatt hour to $50 per megawatt hour. Euros per megawatt hour. It's crazy.
Yeah. So yeah, fertilizer prices up 77% over the last 12 days.
Yeah. Oh yeah. Sorry, I should say that the price is from yesterday. It's not incorporating today's action. Excuse me.
Strait of Hormuz, choke point handles roughly 20 to 30% of global traded fertilizer.
Yeah.
Shipping has dropped, of course, over 70%. You see that chart? There's actually a chart circulating online showing the oil tankers crossing through the Strait of Hormuz.
Yeah. Did you see the one that was like going and then like turned around halfway? I mean, I'm smiling because only it's just so kind of preposterous what's going on. But you can literally track all these ships, and it literally just did a U-turn in the middle, and you can't blame them. There was one that was bombed yet, or two of them were bombed yesterday, or they're starting to mine the Strait of Hormuz. This is not going to go well.
It's not great. Keith, I don't want to say how do you see this shaping up, but I mean, I don't know, maybe from an outside observer, obviously, the U.S. administration leaks to the public probably what they want to hear or see, but Twitter being relatively unfiltered, it feels like this has escalated well above anyone's expectations.
Yeah, I would agree. I think, when this first started, it was a Saturday, like late Friday night, Saturday morning over on our side of the world. I mean, I think a lot of people were expecting it could be over on Monday. They'd have some kind of agreement. A lot of people were concerned, wow, they're not going to get the price movement they thought they were going to get on Monday. And now we are, almost 2 weeks later. So the longer it grinds out. And Rich, is energy infrastructure being permanently destroyed over there, or is it just the flow?
The thing is like,
of energy?
What I understand is like so many of these refineries rely on constant egress. So they don't have storage on site. Excuse me. They do have some storage on site, but the whole premise, the whole way that these refineries, remember, some of these refineries are hundreds and hundreds of meters long. There's probably tens of thousands of kilometers of piping that go up and down and this and around. And you've got like, the distillery, because that's what it is. You effectively distill crude oil to get the different types of cracked hydrocarbons for all the different applications. And so you have like these pump jacks in the oil field. That oil gets put in through a pipeline. It goes to the refinery, and then that refinery then distills the product and turns it into different and then they get put on the ships, and then it goes out to the Strait of Hormuz and around the corner and whatever. The problem is if you have a bottleneck, you can't just keep producing, right? Because then you have no. You have like, I don't know how to explain it. Like you think of it like, like a company that makes whiskey. You need people to keep drinking. or else you basically just have a buildup of product, and that's also dangerous, right? Because if that gets attacked or whatever, you have spillover
Rich,
or whatever.
it might be similar, to your explanation. When the Germans shut down their nuclear power plants. I remember I asked you, well, can they just turn it back on tomorrow? And you said,
Yeah.
no. It takes a lot of more things
so
to
what
do
they
to get it up running
so
again.
I think out of an excess of caution, which makes sense because these buildings effectively are worth billions and billions of dollars, a lot of them are shutting down because you can't just put product on a ship that can't get out. And so that's what I think is happening. Yes, there's been some damage to some infrastructure for sure. You can't that's sure. But I think the real thing is that they're shutting down the production because they can't then ship it out. I think that's what's really going on. That I don't know. Again, there's as Doomberg alluded to, there's tons of propaganda, but that's really what I think the issue is. Unless you can put it on the boat and then the boat leaves and then you start. Remember that process. These processes are continuous. Right? They never turn off. They run 24 hours a day, 7 days a week in perpetuity. And so if you can't just keep producing product unless you have a mechanism to basically release that inventory into the market.
I think what we're going to see here is that the energy story is going to spill over into the rest of the global economy. So input costs are going to rise, margins will get squeezed, and that's going to affect the credit world as well. Because I think you're increasingly going to see private borrowers are just not going to be able to keep up with payments. And by the way, like people are thinking, well, like is that like the dude in Red Deer? No. I take that back. The dude in Winnipeg, boring. I don't mean that. I mean these small and medium-sized businesses that are boring, and they're getting squeezed with their input cost with whatever they're doing, and they're not be able to pass it along to their end market. Again, I think all of this is going to be intertwined, and at some point that will start coming out as the story, and then that's when the air pockets, just get.
There's also like so many input costs that we don't even think about. Like you guys asked me to look up helium, and thank God for Claude. Like helium is helium.
Claude.
So helium, I just learned 5 seconds ago. Helium is an exceptional thermal conductivity, makes it ideal for cooling during the process of ion implantation and plasma etching. I have no idea what any of that means, but the key point, the takeaway, is that it's vital for the production of semiconductor manufacturers. Lo and behold, helium is a non-renewable resource extracted as a byproduct of natural gas. The same thing that there was no business case for. And I think what we're is that fool me once, fool me, you just can't get fooled again. You know what I mean? And so we learned from the invasion of Ukraine from Russia that obviously energy is extremely important. No fossil fuels are not going away. Natural gas is an input to fertilizer, and now we're understanding an input to the production of semiconductors. Hopefully the lesson to take away from this is that all the people who've been screaming from the rooftops to destroy our global energy infrastructure were wrong and should be flogged. But the key thing is that there's going to be loads and loads of sort of second and third order effects that we really don't even appreciate right now. And it could take months, if not years, to sort of shake out.
Rich, there's an interesting thing on I guess the Department of Energy says they're going to release 172 million barrels from their
million.
172 million barrel release will take approximately 120 days to deliver based on planned discharge rates. But there's an interesting commentary. I think it was I can't remember where he was from. It was Jeff Curry there. He's the he runs the energy fund there at one of the big banks. But I was listening to an interview with him, where she was basically, he's like, listen, I think everyone's making a big deal about this, but it's really about, call it 1.4 million barrels a day. And he's like, right now, you've lost about 3 to 5 million barrels per day, 3 to 5 million, due to obviously the war that is ongoing. And he's like, this is like a one-time release, right? So depending on how long this war goes on, his view anyway, his commentary was the move for oil prices is ultimately higher.
Yeah, it's flow versus stock, which is something I stole from Tracy, friend of the show. She wrote I wish I had thought of that myself, but like she wrote a really interesting piece about how this release of barrels into the market, it'll patch things up for 5 seconds, basically. I mean, this is like what's infuriating about the politicians who have tried to convince humanity that we don't need fossil fuels is that, you know, in economics and frankly all of our lives are lived at the margin. Human beings consume 105 million barrels of oil per day, not because of some, like, you know, conspiracy. It's because it's super useful. And if you just screw with that supply and demand dynamic, you can have massive consequences to the lives of everyday people. And that's exactly what we're seeing.
Yeah, so we're seeing, obviously, I think the Chinese now have halted exports of diesel, gasoline, fuel for airplanes there, jet fuel. And so I mean, the implications are significant. I think I was reading the news today that like airlines are all raising their fuel surcharge taxes. Cathay Pacific just raised it, I think $400 per trip.
Yeah.
So I mean, it's not insignificant. And I think there's
gasoline
price gaps.
Steve, that's a really good point. Yeah, just to mention that for a second. So if you know the airlines $400 per trip, that's a big chunk of money.
I got pulled up right now, but it was a significant jump.
But if you're yanking that out of everyone who's traveling, so say a family's traveling once a year, family of 4, Loonie hour math, 1,600. But again, it's all, but companies are traveling and stuff like that. It's all less money available for your economy to grow productively, instead of these higher costs. By the way, the airlines, they first created the like an temporary oil tax or something back in the O's when oil went up significantly. And they all claimed it was temporary, we'll withdraw it. They had special permission for it. 15 years later, this thing is still there.
Yeah, like the GST.
Yeah, it is not going to get taken away once they do again. Guys,
okay, Keith, just to clarify. So for Cathay Pacific, so they've doubled the increase. So it used to be oil. The old surcharge was about $73 US. It's now $149 starting next week. So it's $149 US, 200 Canadian roughly per flight. Since the charges per segment, a round trip long haul will add about $300 to $400 in fuel surcharges. So there you go.
Isn't it great? At the end of the day, it's always like the dude who pays for everything.
Yeah.
Rich, that airline index is down about 15% now, year to date.
Yeah, not surprised.
So,
by the way, one of the biggest trades we ever did, it was back during, I think it was 06 or 07. Is that when oil spiked to 147?
Yeah, 147.
I think I shared this story before, but just sharing because I think we're gonna get these opportunities again coming up. So when you get a super spike in oil, we all realize, hey, this is not going to last. This will turn, and so we started researching very quickly. Which sectors, subsectors, and stocks had the biggest negative correlation to oil, and it was the airlines. Of course, that's what you're looking at. So then we said to the guy that was covering that sector for us, okay, which is the best one to buy? And it's funny. He said, Keith, they're all crap. Like, just close your eyes. So we bought 4 of them. It would have been like American Airlines when they were United, and I think Delta at the time. And then sure enough, after oil, they did that, water spout spike and came off. Those things bounce about 20, 30% afterwards. So when you get these, I don't think we've had this super spike long enough yet for energy. But if we continue to do this, the airline stocks should go down. So anyone that's really, they're energy intensive into their input costs. So you can just keep thinking, just use your mind and which ones would get hurt by that. They're the ones that are going to bounce the hardest. And then the other ones that gone up high, like they will bounce the other direction.
Yeah.
So speaking of bouncing in directions, I just received an email then. It's I'm invited to a webinar session. It's going to provide a comprehensive introduction into private credit, what it is, how it works, and how it can fit into your investment portfolios.
They're looking for some liquidity, Keith.
Yeah, they are. Yeah,
You're the
absolutely are.
patsy at the table.
Yeah, I'm not a patsy at this table. No way. But talk about like not reading a room. This is from an industry group email, like this.
You can send them the recording of this podcast.
Yeah, these guys are sending it out. They're thinking, like, I don't know who's buying this stuff. As you said, Steve, it would be the patsy right now. And again, that doesn't mean that it's all wrong, but everyone else is trying to get out. So maybe that's what they're doing.
Hey, well, speaking of energy prices and obviously the knock-on effects, of course, hitting markets, of course, that are more reliant and dependent on it. There's been gasoline. Have you seen those like videos of the long lines at the gas stations in China, Rich? There definitely seems to be an element of like hoarding going. Yeah, rationing, hoarding. I don't know. It feels like almost like the toilet paper thing during the pandemic again. I think people are.
Yes. Thank you for reminding me about a very interesting time.
So that's going on. There's been price caps on gasoline in Korea and in Thailand, or is it Thailand?
I mean, I imagine any
Taiwan,
country that has
Taiwan.
Any country that has a massive energy deficit will be vulnerable from this kind of price shock. Guess which country has a massive energy surplus, Keith?
USA.
Oh no, they're about basically balanced. They're neither here nor there.
Canada.
Yes, Canada has a massive energy surplus.
No, but if you look at it from the Strategic Petroleum Reserve perspective, I don't think we have anything. Like we don't have reserves. Yeah, we don't have anything in.
Sorry, go ahead. Sorry.
Well, I'm waiting for you to waffle on about it.
Well, we don't have reserves, but we don't need reserves. Like we have 160 billion barrels of reserves. We have two.
This is a conversation where reserve doesn't equal reserve. Everyone,
it does.
We're talking about two different kinds of reserves.
How quickly can you ramp up those oil sands, though? Realistically,
we do. We produce 5 million barrels of oil a day. We only consume about 2.5 million barrels a day. We refine about 2 million barrels a day. We're connected. We're inextricably connected to the U.S. energy system.
Rich, there's not enough incremental pipeline capacity.
I'm sorry. Canada is not quote unquote vulnerable to
but
spikes the way other countries are. You cannot compare.
Rich, your point is fair. So I think like Japan is incredibly vulnerable.
Right.
It's probably one of the most vulnerable countries on the planet.
Yeah, they import every drop
Europe.
of.
I think they're in trouble.
So
yeah. Go ahead. Sorry. Go ahead.
Well, yeah, there's an article out that says, Canada is, quote, urgently exploring options with provinces and the energy industry to boost oil supply as trade disruptions caused by the war in the Middle East spur huge volatility in global crude markets. Again,
where's this article from? Who's writing that article?
Bloomberg.
And who's quoted it?
I'm gonna get angry now.
So Tim Hodgson, our energy minister, is obviously out. He was tweeting and saying, I spoke to provincial energy ministers from BC, Alberta, Saskatchewan about energy market and the IEA's coordinated action to support global energy security. Team Canada is prepared to do our part and are actively exploring options with our oil and gas industry to support. You know what I mean? It's just the irony.
The irony. Yeah, absolutely.
This is just fluff. This is just fluff that should infuriate every red-blooded Canadian. We've been talking about this for years. Fossil fuel demand is not going anywhere, and we have a moral imperative to build out our supply chain, and this is exactly the point and exactly the reason.
So I can't wait to hear the urgent response from this when it comes out.
We need one of those. We need one of those carbon capture pipelines.
It's just such garbage. Anyways. I feel like that feel like old man yelling at cloud. That's how I feel, Keith.
Oh, Rich, you like this? Speaking of yelling at the clouds, Ursula von der Leyen.
Oh yeah. Tell us the story.
So she was out. She tweeted. So she put this big tweet out, and she had a big speech. And she says Europe needs homegrown, low carbon energy sources. So for those that aren't familiar, she is the president of the EU Commission. So she says Europe needs homegrown, low carbon energy sources. Nuclear and renewables together have a key role to play. Nuclear energy is available around the clock, providing electricity all year. Europe has been a pioneer in nuclear technology, and we can lead again.
All of that is true.
So I'll let you take it from here.
Well, just like she voted, she was like, so what's great about Twitter is community notes. I think that is like one of the best inventions ever. And what they did was so she was giving this speech at the European Nuclear Summit, with all the flags behind her and the pomp and the circumstances. And then underneath, they basically wrote like Ursula von der Leyen voted to close when she was in Parliament or the Reichstag. I can always forget the name of the German Parliament, but basically she voted to shut down the nuclear power plants in Germany. Remember, Germany used to generate 23 gigawatts. It used to be one of the biggest producers of nuclear energy in the world. And now they're producing exactly 0 gigawatts. To give you an idea, Canada produces 14, and Canada is one of the biggest in the world. So underneath it had like a screenshot of the voting record on that specific piece of legislation. And if you screen down, it was like hundreds of them had voted to close it, and her name, Ursula von, honestly,
at least she can change her mind.
Fine, sure, she can change her mind, but we need to hold these people to account for having horrific views on things that are demonstrably stupid. Is what I'm trying to. Anyway,
there is a bit of lecturing going on, Rich. I agree with that part. Absolutely.
Just like no sense of shame. No sense of shame. I would have more respect for her if she just came out and said, you know what? I'm sorry, I was wrong. Clearly that was a mistake. I'm changing my mind. Anyone
who's married has said that at least 5 times on this trip. Oh, sorry.
Just like listen, we should be.
Hey,
anyway,
something a bit similar. This is my beach read.
Nuclear War.
Is that a novel or a prophecy?
It is. I want to reach out. Her name is Annie Jacobson. The book is called Nuclear War. She was interviewed on Rogan a few months ago, and it's just.
What's it about?
It covers the process. What happens when the U.S. they believe they are attacked by an enemy with a nuclear warhead, and what goes through that entire process and how it develops. So she, you learn there's a couple of very severe potential events, like how powerful, the Americans and the Russians, what they've accumulated in nuclear arsenals, but also the process in place for actually launching them. It's not as sophisticated as you think.
Oh, boy.
It's and also like these sort of defense systems. We're hearing about that, of course.
Thanks everyone for tuning in.
Yeah, but this is an outstanding book. I want to see if I can get Annie on as a guest. It's really interesting. Here's something for you, Rich. If Wyoming was a country on its own,
it'd
probably be the 3rd or 4th most powerful nuclear state on the planet.
I don't know if that's comforting or not, Keith.
Yeah, that's where they hold them. I was
right in the
doors.
middle.
The doors in some farmer's backyard, they open up and this thing goes.
You did a live Loonie Hour event there.
Keith,
but they do talk about there's always one guy that's always next to the president at all times. You never notice him, but he's carrying the football. That's what they call it. It's a satchel with the codes in it and everything. Anyway, it's a.
Do they talk about? Does she talk about mutually assured destruction and how that plays with this into the psychology?
Yeah, absolutely. So in this scenario, going through everyone agrees. So the Russians and the Chinese and the Americans, they all agree that you just don't launch because it means you're also going to be the amount of time. It's immediately picked up by satellites as soon as some rocket burns on the platform. They can tell immediately that, oh wow, this is not good. And then other things develop, and so everyone's going to die when it happens. So in this example, is the Koreans who initiate something, Rich, you would love the submarine stories. It's not the battleships that you want or you got to be worried about. It's these submarines that they're amazing.
Yeah.
But the whole thing is about, the theory is deterrence, to keep someone from attacking you or attacking each other. And it's just this agreement, but it just takes one guy to sort of move off course. Then the Loonie hour is over.
Jeez, that was
so
depressing.
The bad news is the whole world gets just like incinerated. The whole world gets incinerated. That's the bad news.
Well, the good news is we get Star Trek 3 and warp drives, because that's a premise for Star Trek 3 or 4, whichever one.
Well, the good news is it happens very quickly, so you don't have to worry about it.
Yeah, that's right. Hopefully we'll win a Stanley Cup before that happens.
Yeah.
Well, thanks, Keith, for really putting some cold water.
Something other. Let's talk about the nuclear concept in a much softer way, but it's going to go back to what policy is going to be. So if we get, just say the war continues, an air pocket pops, for private credit and all that stuff, everyone should be prepared to see all central banks cutting rates. I don't think the Western world are going to raise rates to try to offset inflation. They're going to be cutting rates to try to, unless their currency goes in the toilet, which would happen to Europe, by the way. But you're going to see fiscal stimulus, to the moon. So everyone thinks Canada has a lot of deficit spending right now. What are we about? What was it, 70 billion for the last year?
No, 79 was the projection, but I will bet you a Twinkie that it will not be 79. It will be much higher than that.
Yeah, absolutely. And so you're going to see this thing increase like 50%, 100%. And everyone's doing it, which could create this explosive upside in equity markets. Yeah. So you could see equity markets going up when everything else is sort of crumbling, especially if you get the bond world crumbling. Then money will just run away. So money will run away from that sector, into equities. It's all fascinating where we are.
I mean, we've just talked about the wall of debt issuance over the years. And I just, think about how costly this war is going to be. And as you're suggesting, right? I mean, you could actually end up in a scenario where fiscal stimulus ramps higher from here. And I have to wonder who's going to be buying all the debt.
I know. Richest lady friend in
Carolyn Rogers.
Yeah. Carolyn, the Fed. Oh man, ECB is going to get drunk on QE. They got to buy a ton of it. So Steve, it'll be QE instead of the private sector buying the debt.
Maybe that'll give you the liquidity you need to buy those pre-cons again.
And your private credit funds.
Yeah, that's true.
The playbook is clear. They've done it over and over again. 2008, 2016, 2020.
They got all the air cover.
I mean, they need air cover.
By governments running extreme deficits in this scenario and cutting rates and doing QE. Again, it's just trying to maintain a continuance, of the Bretton Woods agreement that everyone made. And, I've been saying now for a while, that experience is over. All the policy tools they created and everyone agreed to use, they're no longer effective anymore. So ultimately, I mean, when you're doing QE, you're just delaying, debt destruction. That's all it is. So we are going to eventually hit this, this solved debt crisis that people talked about. Ironically, maybe it's not energy markets that blow up, with the war. Maybe it's someone's bond market. We can go there. So again, everyone, don't think everything is nice and calm and quiet now. There's a lot of stuff happening underneath the surface.
Thinking about the Canadian economy again, Rich, I can't think of a better scenario in terms of having the political air cover today to be building pipelines. Before the war broke out, right? The Carney administration has been using, Trump, orange man, bad, perfect air cover to basically go and build a pipeline to the West Coast there. And now you layer on this war in the Middle East and you're like, man, if you can't rally a country to support the building out of a pipeline or multiple pipelines today. It's never going to happen.
I agree. But I mean, Canadians, I'm sorry, I'm going to get blowback for this. We're brainwashed. We're not. We have not. There's still people who just insist, whether it's, I'm not going to name their names. I don't want to give them the oxygen, but there's loads of people who work for the major media corporations in our country who are still under the impression that we don't need fossil fuels. And I submit to you that Canada has a lot of them, and we are an ethical and relatively sustainable producer. And of course we should be doing it. We have a moral obligation to do it.
I think that makes it easier, though, Rich. They'll just be told which way to walk and talk. I'm serious.
I believe
and
you.
Then this is broadcast, across the medias, and everyone will go, oh yeah, it's a good idea. And then they can go full on into it. So I think you're right, Steve. I think this could happen.
How easy is it to sell it publicly today? Oh my God. You like,
oh man, one CBC news story, they'll do it.
I mean, it should have been easy. It should have been easy when Ukraine was invaded.
Yeah.
But I guess fool me once, you just can't. You can't fool me again.
Rich, we fooled you a lot of times. So.
Yes, I know. I'm very foolish. I have a lot to learn. That's true.
I think that's a good spot. If you want to come and fool Rich in person, we have 2 events coming up. March 23rd in Calgary, the Loonie Hour Investor Series with special guests Bob Sacamano, Ben Rabidoux. March 23rd in Calgary, March 25th in Vancouver. Still some tickets available. In the description below, there'll be a link to an Eventbrite page where you can go and pick up tickets. And come hang out, have a beer, have some food, shoot the breeze, and Rich will be loading up the chart deck, and should be a good time. There you go. Well, Boomer, enjoy your time over there. Thank you everyone for the support. All we ask again, if you found this episode of any value, entertainment, all we ask that you share it with one friend or family member and help us continue to build the Loonie Hour community. And as always, we'll see you next week.